Hi and welcome to Swiss Codes Daily Market Talk. It's Friday, June 6th. Mounting tensions between Donald Trump and Elon Musk spice up the headlines. Tesla is coming to a very dark tunnel. The rest of the market is waiting for the US jobs data to be released before the weekly closing bell later today to assess the potential damage of Donald Trump's trade war on the US jobs market. And silver is preparing to finish this trading week with an almost 10% rally. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. Popcorn sales will pop. That's my best prediction for today as the world watches the incredible escalation of tensions between Donald Trump and his once best buddy Elon Musk, as Elon Musk joined the mounting chorus of critics out there regarding Donald Trump's big and beautiful tax bill. But because nothing is reasonable or understandable anymore, the tweet war between the two very famous names became very ugly and very quickly and ended with Donald Trump saying that the easiest way to save money in our budget, billions and billions of US dollars, is to terminate Elon Musk governmental subsidies and contracts. To which Elon Musk responded that Donald Trump is involved in the Epstein file. So it's very sensitive, but this is what's going on right now. So the letter exchange of words resulted in a 14% slump in Tesla's stock price yesterday. The stock price is still a touch higher than the wake of Donald Trump's election as the US president, but we can actually say at this point that most gains have been given back. And of course, losing the White House's support would be terrible for Tesla that's been eaten alive in Europe and Asia by the Chinese competition. And well, partly because of Elon Musk's irritating involvement in world politics, because Tesla's self-driving cars and robo-taxis need legislation to be friendly, and legislation is Trump. So QED, the hype around Tesla, is not looking good anymore. And Trump has a new friend, mind you. Well, maybe not friend, but some kind of a friend, because apparently Donald Trump and the Chinese president Xi Jinping finally talked on the phone. They actually said nice things to each other, according to the reports. Xi accepted to relax his export rules for rare earth metals that Donald Trump's America needs so much, so badly to stay great, while both leaders invited each other over and they apparently both accepted these offers. How nice. We'll see how long this friendship lasts, but VanEck's rare earth and metals ETF jumped nearly 4% on the news yesterday and close to 10% just this week to above the 50-day moving average, and has room to extend its gains if of course the tensions between the US and China continue to ease. Now, speaking of tensions, there's growing evidence, at least from this week's jobs figures, that the US jobs market could be coming under some pressure after trade uncertainties of late, while Tuesday's job vacancies data hinted at more job openings in the US in the month of April, while Wednesday's ADP data from the US came in significantly softer than expected, lower than the 50,000 job addition mark for May, and yesterday's weekly update from the US again warned that the jobless claims there last week rose to the highest level since October. Now, today, all eyes will be on the official jobs data from the US. The US economy is expected to have added around 130,000 new non-farm jobs in the month of May, with average hourly earnings slightly higher month on month, but slightly lower year over year. The unemployment rate, on the other hand, is seen steady near the 4.2% mark. Now, softer than expected set of jobs figures from the US today could further boost bets that the Federal Reserve would cut the interest rate sooner rather than later to give support to the economy if the wages data remains sufficiently soft as well. But another surprise strength in the jobs figures from the US today would actually boost optimism that the US economy is, well, somehow weathering the Trump shock, the Trump tariff shock quite well, and probably boost appetite in US stocks before the weekly closing bell. Now, activity on Fed funds futures gives around one chance out of three that the Fed could actually cut interest rates in the month of July. But the expectation is for September right now, and that probability of July rate cut and the 2-year yield are, in my opinion, the ones to watch how investors read the jobs report of the day. The US 2-year yield is actually sitting near the 3.90% level this morning. That is still well below the 4.40% mark of the beginning of this year. Either way, the pressure that we see on the US dollar will likely continue on prospects of weakening US growth due to the tariff shenanigans and or on dovish Fed expectations. So the euro dollar flirted with the 115 psychological level yesterday after the European Central Bank cut its interest rates by an additional 25 basis points as widely expected by everyone, but signaled the end of the policy easing for now. So announcement significantly trimmed expectations of a summer rate cut by the European Central Bank, but did not take the possibility of further support off the table should trade tensions hit the Eurozone economies, as the European Central Bank now expects inflation in the Eurozone to ease to 1.6% mark next year and growth to stabilize around 1.1% level, meaning that the ECB is still giving itself the possibility to do more if needed with soft inflation but also soft growth prospects. So the European equities welcomed the ECB decision of yesterday. The Stoxx 600 added a meager 0.16%, but that was despite a sharp rise in short-term yields amid the ECB decision. Investors are also ready to push the index higher if news from the trade front sound encouraging in the next days, because yesterday's meeting between Donald Trump and the German Chancellor, Mr. Merz, went, well, not too bad, apparently. They still don't agree on many things, starting from Ukraine, but Merz is applauded for having avoided public humiliation. This is what the diplomacy has come down to, avoiding a public humiliation faced with an unpredictable man. But elsewhere, the Nikkei is up this morning and the Japanese yen is down after the latest data showed a significantly higher than expected decline in Japanese household spending and a better than feared bond auction in Japan yesterday. In the UK, cable traded above the 1.36 mark for the very first time in more than 3 years, and that despite some nervousness regarding the risk that economic data that's published by the ONS, so the Office of National Statistics of the UK, is not, well, accurate. In the energy space, the US crude remains sold into the $64.20 per barrel mark for the fourth consecutive session and is slightly under pressure this morning. Inability to clear this resistance should actually trigger some more profit taking into the weekend or at the beginning of the next week and send the price of a barrel below the 50-day moving average that currently stands near the $62.40 per barrel mark. Elsewhere in commodities, well, silver rallied nearly 10% this week. The sudden surge that we saw in silver's price is put on the back of renewed interest from momentum traders as the price of an ounce cleared an important psychological resistance at around $35 per ounce level, touching a 13-year high. Now, the mint ratio, the ratio between the price of gold and silver, is being pulled lower as a result of a bigger rise on silver prices this week versus gold that's stagnating near its all-time high levels. So this mint ratio is currently around 93.50 level and has historically been between 60 and 80 and between 80 and 95 since 2022. So there is room for further downside correction for this ratio to return to average levels, and that would mean that the silver could rise more. So this is all for this week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.